Hello, everyone, and welcome to Options Education Month. My name is Diana Stoparic, and I'm joined with Tony Zhang, who is joining us from OptionsPlay. Today, he'll be going over how to choose a strike price, a very common question that we as instructors get for new options traders or even veteran options traders. So, Tony, thank you for joining us today. How are you?
I'm doing well. Thank you so much for having me. And as you say, this is probably one of the most common questions that we receive as educators and traders as to selecting the right expiration date and strike price for all types of strategies. So really looking forward to talking through, best practices for how to select expiration dates and strike prices.
Perfect. Sounds great. I'll let you take it away, and then we'll have the Q&A at the end.
So I think for investors, the most common question is really, why is it so important to choose, the right strike price for the right expiration date and strike price for your trading? And for me, this really comes down to the fact that choosing the right expiration date and strike price based on our best practices is extremely counterintuitive. And choosing the right expiration date and strike price, we tend to find a lot of investors will carry what they've learned from equities, which is buy low, sell high, which is something you still want to apply to options trading, but doing it in a way that makes sense with respect to expiration dates and strike prices. We tend to find that, unfortunately, investors apply this buy low, sell high concept to options in the incorrect fashion. So just as a general rule of thumb in terms of how we think about trading options, we really want to think about the fact that when you buy low, sell high, you're using a concept for equities that may not apply here to options. So when we think about options, the general rule of thumb that you want to have is that whenever you're buying an option, you want to use a longer dated option that's usually at the money or potentially even in the money. And then when you're selling options, you want to sell something that's shorter dated in terms of expiration, that's out of the money. And those are some of the things we're going to talk about here today as far as the different strategies and why it's so important to use these general best practices when selecting an expiration date and strike price. So when we talk about options here, when we're talking about buying, we'll split this presentation between buying versus selling options. So if we first start thinking about buying options, this is really where longer dated options make the most sense, because we want to think not only in terms of time decay, we want to think about time decay per day. And for those of you that are just starting out with options, you're going to learn that time decay is one of the things that really is different between trading stocks versus options. When you're trading options, you want to make sure that time decay works either in your favor or against you, whether you're buying or selling. So as your buyer, time decay is actually working against you because it erodes the value of the option as you hold on to it. Now, most investors think about time decay in terms of absolute time decay, how much they expect to experience over the life cycle of the option. But what really you should be focused on is how much time decay there is per day. For each day you're holding on to an option, is the value of that option eroding relatively quickly or relatively slowly? And as a buyer of an option, you want something that's eroding relatively slowly. So as a buyer of an option, that's why it makes more sense to buy a longer dated option. Longer dated options erode at a lower lower amount per day. So we tend to find that you have to go out about 60 days to buy a longer dated option. And then when you're thinking about strike prices as well, depending on which strike price you choose, some will decay faster, some will decay slower. But you also have to think about the sensitivity of that strike price to the movement of the underlying stock. As a buyer of an option, you generally want higher sensitivity. So as the stock moves in the direction that you expect it to, you're actually, you're going to be able to have a profit from that. And as the trade goes against you, you want that decay or that sensitivity to actually decrease. So that's why whenever we're buying options, we want to buy an at the money strike price as a starting point. You can choose and move away from that depending on your views of the underlying stock. But we always find that when you're buying an option, you want to start off as at the money. And then when you're selling options, we tend to find that it's the opposite. Now, we tend to find that some investors, when they're selling options, they go for longer dated options because that's where you get the most amount of premium. But that's again, the counterintuitive part of options trading, because you want to be concerned not about how much premium you're collecting over the lifetime of that option. You're concerned more about the option premiums that you're collecting during per day. So shorter dated options will actually decay at a faster rate. So if you're selling an option such as a cover call, a cash secured put, or a credit spread, you actually want to use options that are only relatively short dated. About 30 days out from expiration is usually a good starting point. And because whenever you're shorting an option, your risk to reward is actually skewed against you, because your potential reward is limited and your potential downside is theoretically unlimited. So that's why whenever you're selling an option, we tend to favor selling out of the money options, where the exposure that you have to the movement of the underlying stock are relatively small, that could potentially move against you and cause losses in the underlying trade. And we're going to explore some of this when we look at the individual strategies as to picking the right expiration date and strike price for each individual strategy, because we have back tested each one of these strategies and have formed best practices around expiration dates and strike prices for each strategy.
Now, Tony, if you don't mind me asking, with time decay, is it constant? So if you look at 60 days versus 30 days versus 10 days, is it the same amount, or is it going to vary?
So that's a really good question. And the answer is it does vary. Time decay actually accelerates as you get closer and closer to expiration. And that's why when we're buying, we want to favor the longer dated options where the time decay is relatively small. And then when we're selling, we want to favor the options that are accelerating in terms of time decay, the 30-day options where they have faster time decay. Because as a seller, you want the value of that option to evaporate as quickly as possible. As the buyer of the option, you want the opposite. You don't want the value of that option to erode very quickly. So that's why we find that when you're buying an option, you want to buy longer dated options. And then when you're selling options, you want to sell shorter dated options. We're going to dive into this a little bit more, but when we're thinking about expiration dates and strike prices, when you're buying an option, as I said, we want to minimize time decay, and we want to have longer dated options that have lower amounts of time decay. When we're selling an option, we want to maximize that time decay. And then when we're thinking about strike prices, this is really where we have to look at probability and the sensitivity of the option that you're buying or selling to the underlying stock price movement, because theta, which is time decay, is one of the major considerations to determining the right expiration date. And then delta, which is the major consideration that you need when selecting a strike price. So delta gives us two things. It gives us the probability that the option will be in the money at expiration. And it also tells us the sensitivity of the option that we're buying or selling to the underlying stock price. So whenever you're buying an option, a higher delta will maximize the sensitivity of the option that you have. And when you're buying an option, the risk to reward ratio is skewed in your favor, meaning you have limited losses whenever you're buying a call or a put. In theory, unlimited upside when you're buying a call or put. So you want higher sensitivity to the underlying stock price. So if it moves in the direction that you expect it to, you're able to have a sizable move from the underlying option with respect to the stock price. So that's why whenever you're buying an option, you actually want a higher delta and a higher probability of profit, which is what you get with a higher delta. And then when you're selling an option, this is really where you generally want to have a lower delta, because you actually want to minimize the sensitivity of the option to the underlying stock price, because as the stock moves higher or lower, that has a negative risk to reward ratio to option sellers, because the premium that you collect, that's the most you can make on an option selling strategy. Yet the downside is fairly substantial if the stock goes in the opposite direction that you expect it to. So lower delta, lower sensitivity, and a higher probability of profit favors whenever you're selling an option. And then when we think about probabilities, there's really two probabilities that as an options investor, you want to think about. There's two: probability of profit and probability of expiring worthless. When we think about probability of profit, this is really looking at what is the potential outcome, or what is the potential price that the stock will likely trade in the future? And we usually calculate this off of the implied volatility of an option. This gives us insights into the potential risks and rewards of the option strategy that we're trading. It gives us a sense for what is the potential best case scenario, what is the potential worst case scenario, and being able to weight that that risk to reward ratio by its probabilities is key in understanding the potential outcomes of a strategy, and really is utilized in helping us optimize around the best practices for selecting strike prices. And the probability of expiring worthless is also very important for certain strategies. Any strategy that involves a short options leg, so whether you're selling a cover call, a cash secured put, or if you're trading a more complex strategy like a credit spread or a straddle, the probability of expiring worthless is very important in understanding what is your risk of assignment, what is your risk at exercise of potentially being long or short the stock as a result of that. So it's very important to understand what is your potential outcomes and what is your potential risks with respect to exercise and assignment. So as options traders, you really need to pay attention to both, but specifically as an option seller, you need to be focused on the probability of expiring worthless. The probability of an option expiring worthless tells you the inverse of what is the probability of being assigned.
And I think that's really important as well, is a lot of times I'll have newer options traders who will say, let's say in the case of buying a call, a fairly simple strategy, they'll say, I want to pay the least amount of premium possible. Well, the least amount of premium possible has the least chance that you're going to make that money, right? So sure, it might be 5 cents or 10 cents, but it could just as easily be that you lose that entire value. So it's not always worth it to just look at the cost of the premium. You need to understand, well, what's the likelihood of me making money or losing it? Because a 100% loss is a 100% loss, even if it's only 5, 10, 20 cents, for example.
Yeah, that's exactly right. And this is what I mean in terms of carrying what you learn from equities over to options can sometimes be counterintuitive, because as an equity trader, you want to buy stocks as cheaply as possible, right? But with options, the cheapest options usually have the least probability of success. And I think the best way to think about this is thinking about like a lottery ticket, right? A lottery ticket has a very high risk to reward ratio where you spend a couple of bucks and you could potentially make tens of thousands or maybe millions of dollars, but the probability of that is extremely low. So when you buy a really cheap option, while a lottery ticket may not be may be a very extreme example, but I think it illustrates this concept that very, very cheap options have extremely, extremely low probabilities. So you have a very high probability of losing 100% of the premium that you pay when you buy a very cheap option. Vice versa, if you buy a more expensive option, an in-the-money option or at the money option, you have a much higher success, a probability of success, but it does come with the trade-off with a lower risk to reward. You can't expect that a few dollar investment could potentially pay off into a much larger payout. But when you're buying an at the money option or in the money option, you have a much higher probability of success with a lower payout. That's the trade-off that you're always making with respect to options. And I think you really have to think about options as really just a spectrum of risk. Where do you want to be within that spectrum? It's not to say that you shouldn't buy those out of the money call options. It's just that if you're going to buy those out of the money call options, understand what you're purchasing and understand the probability of success with one of those strategies. So moving on to looking at some specific strategies and talking about the best practices for each one, let's start with talking with the common strategies that many investors trade. And I'm going to start off with buying calls and puts, because a lot of investors, I think the most attractive option strategy is buying a call or put, because it's a strategy that has limited risk, right? So whatever you pay for it, that's the most you can risk. And both strategies have, in theory, either unlimited reward or very substantial reward if the stock was to decline to zero in exchange for a relatively small percentage risk of the underlying stock price. So this asymmetrical risk feature that you receive from long calls and puts is usually what attracts a lot of investors to options. So what I want to talk through is just the best practices when you're going to use this strategy. While it may seem very attractive to buy these out of the money call options or put options because they're very cheap, that's exactly what we were just talking about, that buying those out of the money call options have very low probability of success. What you're better off is buying what we consider slightly in the money calls and puts. And that's usually about a 50 to 60 delta. A 50 to 60 delta means that that call option has about a 50 to 60% chance of being in the money at expiration. And make sure that we don't confuse in the money versus profitability. In the money just simply means that the call option the stock will be above the strike price for a call option, or the stock will be below the strike price at expiration. But we usually want to go out about 60 days as a minimum time frame whenever we're buying an option, because going out 60 days allows the time decay feature or factor of that option to be relatively small per day. So if we hold on to this trade for, let's say, 30 days, over those 30 days, we're losing a relatively small amount of premium to time decay versus if we only bought a 30-day option and held it to expiration. And that in the money option means that we have some intrinsic value as well, because when you have the value of an option is a combination of intrinsic and extrinsic value. Only the extrinsic value of an option will decay. The intrinsic value of an option does not decay. So that's one other way that you can continue to reduce the amount of time decay, which again works against you whenever you're buying a call or a put. The second strategy we're going to talk about is a cover call. This is actually one of my favorite strategies for beginners because, one, it's a strategy that doesn't add additional risk to a portfolio. It's the only option strategy that doesn't add additional risk to your portfolio. It's actually reducing risk. And it's really one of the ways that allows an investor to get a sense for selling an option without taking on a fair amount of risk. Because if you were to short a naked call or a naked put, you're taking on a high degree of risk. By selling a cover call, you're able to see the same outcomes as selling a naked call or put without taking on that additional risk. So, and when you're selling a call option, especially a cover call, it allows you to potentially hold a short option to expiration, which is extremely valuable as a learning process because it gives you a sense for how the value of an option fluctuates as time goes by and as the stock moves higher and lower. So whenever we're selling a cover call, we usually like to go out about 45 days as a starting point. 30 to 45 days is usually the starting point that you want to use for a cover call. Shorter dated options accelerate the time decay, and then you actually want to buy an out of the money call option. And for cover calls, our back test actually shows you want to buy a pretty far out of the money cover call. Sell a pretty far out of the money cover call. And the reason for this is because I tend to find that a lot of investors will sell a very close to the current price cover call because those are the cover calls that generate the highest amount of income or the highest amount of premium. And many times we're taught that cover calls is an income generating strategy. And while that is true, the income portion of a cover call is actually relatively small in comparison to the risk that you're taking by buying that stock. So we tend to find that it's better to actually deprioritize the amount of income that you receive and prioritize the upside of the underlying stock before that stock is called away, before you lose that stock. So for cover calls, we tend to find that selling a 10 to 20 delta cover call is the optimal strike price to use. This gives your stock price significant amount to run to the upside before the stock is called away. And in exchange, you get a smaller amount of income, but we tend to find that the capital appreciation that you can achieve by selling an out of the money call option will offset the small reduction that you receive on the income portion of that cover call. So very, very important that when you're selling cover calls, prioritize the capital appreciation of the stock over the income portion of the cover call itself. And then to switch gears here to selling puts, this is actually one of my favorite strategies, and I actually think that this is one of the most underutilized strategies by equity investors. Now, You can sell a naked put or you can sell a cash secured put. I tend to prefer selling cash secured puts because it is comparable to buying the stock outright using a limit order in terms of the obligations that you have. The differences between a limit order and a short put is the fact that a short put does require you to trade in 100 share increments or buy in 100 share increments. A limit order, you obviously can enter for any a number of shares. But when you're selling a put option, it allows you to potentially have the same obligation as putting a limit order for 100 shares to buy the stock at a specific price, but you're getting paid premium to place that order. And that premium, if the order never gets triggered or if the put option just expires worthless, you keep that premium. And if the stock declines below the short put's strike price, you now own the stock at the price that you were comfortable buying the stock at, plus a discount, which is the premium that you've received on that short put, which is going to provide a little bit of downside protection if that stock is to decline after you purchase it. But it's one of my favorite strategies, and I really think it's one of the most underutilized strategies by equity investors who may overlook a short put because it on paper sounds like it has a lot of risk in exchange for very little reward. But if you think about it in comparison to buying the outright stock, selling a put versus buying the stock using a limit order actually has less risk. So whenever I have two options where one option has less risk, I'm always going to try to choose the one with less risk if it makes sense, if the other things make sense in terms of selling puts. So next time you're thinking about buying a stock, especially a stock that you want to purchase at least 100 shares of, I advocate that you take a look at selling puts as a potential alternative. Now, when you're selling puts, same thing with covered calls. You're selling an option, so you want to sell shorter dated options. 30 to 45 days is a good starting point. But with selling puts, because you want to own the stock, we tend to find that selling strike prices closer to the current price. So higher delta, higher probability of owning that stock is what you want to prioritize. And in addition to that, by selling a higher delta or a strike price that's closer to the current price, you're also going to collect more premium or more income that's going to provide that discount on the stock purchase itself. So selling puts is a strategy that I think many equity investors may want to take a look at. Now, switching gears a little to trading strategies. This is really what we want to talk about: debit spreads, credit spreads, and time spreads, multi-leg, what we typically call complex option strategies. So we'll start off by talking about debit spreads. And debit vertical spreads is one of my favorite strategies when it comes to taking a directional view on the market, whether it's a stock, an ETF, because debit spreads allow us to take a directional view with one of the smallest amounts of risk that we can take with respect to options. Because debit spreads, what we're doing is we're similar to buying a call or a put, but because buying a call or a put sometimes is expensive, we're selling a call or a put against that to offset the cost of the long call or long put that we're trying to purchase. And by offsetting some of the cost, we're able to reduce our overall risk on the trade while having a risk to reward ratio that is largely very similar as long as the stock doesn't make a really substantial move. The risk to reward ratio actually is in our favor as long as the stock trades within its expected range. So this is why it's one of my favorite strategies to take a directional view. And because we're buying an option, we want to minimize time decay. So we usually go out about 60 days as a starting point from an expiration date perspective. And then as far as strike prices go, we take what we've learned about buying and selling options and we combine them into one strategy. We want to buy a slightly in the money call or a put, depending on if we're bullish or bearish. And then what we're going to do is we're going to sell an out of the money call, about a 20 delta against that long call or a put to offset the premium that we pay on the long leg. And we tend to find that when we use this strategy, the short leg, the short call or put that we sell against the long leg will usually offset somewhere between 15 to 20% of the premium that we pay on the long leg. So buying a call or a put already has defined risk. You've controlled the amount of risk you take to the premium that you pay. When you use a debit spread, you're actually reducing that risk potentially by another 10 to 20% in my experience when you use roughly a 20 delta call or a put. So you're reducing your risk even further. And by reducing your risk, it has this effect of potentially amplifying your returns if the trade goes in the direction that you expect it to. Because whenever you're able to reduce the denominator on a return calculation, that improves your return calculation to the upside if the trade goes in your favor. So again, one of my favorite strategies to take a directional view. And if this is your first time learning, this is one that, this is how you can go about selecting an expiration date or strike price as a starting point.
And I think as well with the debit spreads and just spreads in general, they show why options are such a great tool, because it's not just buy a call or sell a put, but you can do combinations that can help reduce your risk even more than if you're looking at just buying stocks themselves. So as everyone here gets more comfortable with options and learns more, you'll see that there's almost unlimited amounts of option strategies that you can create, different combinations of calls and puts and buying and selling them to decrease risk or to help maximize the income as well. And I think here, Tony, with your example of the vertical spread, the bull call spread is usually the first one I'll tell people about when they're interested in it. It's really great because you were mentioning it helps to decrease your risk, and it also helps to kind of decrease the premium that you're paying, right? Because you're selling it and you're buying one as well. So a really, really great strategy, and tons more to learn as well. This is the first. It's the tip of the iceberg of so many more.
Yeah, that's exactly right. I usually tell investors that this is the first part in learning about how creative you really can get with options, and learning about vertical spreads is kind of that, as you said, the tip of the iceberg of understanding how you can combine buying and selling options into more custom payoffs based on what you believe the outlook of the market is going to look like. The vertical spreads that we're going to cover here today are simple ways that you can combine calls and puts to reduce risk and define the potential outcomes of the market outlook that you have. And it's so important to define your risk, because whenever you're able to define your risk, that means that no matter what happens when the market goes in the opposite, even if it goes in the opposite direction that you expect it to, you know how much you have at risk. So, the number of ways that you can combine these strategies is really unlimited. And debit spreads and credit spreads is really just the beginning of understanding how creative you can get. So I think that's really a great segue into our next strategy, a credit vertical spread, which is a very creative way to allow you to capture income, but do so in a way with limited risk. Because before we said selling a naked call or selling a naked put has unlimited risk. It has some advantages because it's a fairly forgiving strategy. Because after you sell a naked call or a naked put, the stock can do one of three things. It can move higher, it can move sideways, or it can move lower. And whenever we're selling an option strategy like a naked call or naked put, 2 out of 3 scenarios will be profitable for that trade. It's the scenario where the trade goes against you, where you have unlimited losses or potential for unlimited losses. So a credit vertical spread allows you to have a risk profile similar to selling a naked call or a naked put, where 2 out of the 3 market outlooks can be profitable. But if the trade goes against you, you actually have limited losses. So a credit vertical spread, because the primary leg is we're selling the call or a put, that's really where we want to focus on shorter dated options. That's why we use a 45-day expiration date as a starting point for credit vertical spreads. And then what we're doing is, because we have to buy an out of the money call or a put against that short at the money call or put to define our risk, we usually go out about 20 to 25 deltas to buy a call or a put, and that defines our risk. So we're basically taking advantage of the risk profile that a naked call or naked put provides us, but then defining that risk by buying an out of the money call or a put against that offsets the risk if the trade goes substantially in the opposite direction that we expect it to. So debit and credit vertical spreads, very different in nature, but very similar in terms of how it manages to reduce the amount of risk that you take on a strategy. And lastly, I want to talk a little bit about how you can get even a little bit more creative and take this to an even extreme level to really maximize everything that we talked about here today. So we talked about whenever you're buying, you want to do longer dated at the money. And when you're selling, you want to sell shorter dated out of the money. So we can take this to what we call time spreads. So this is where we talk about calendars and diagonals. And if this is your first time trading options, calendars and diagonals is something that you want to work your way towards. So starting with debit and credit spreads before moving on to calendar spreads. But for those of you that have some experience trading, calendar spreads really maximize everything that we've taught here today, because what you're doing is you're buying that longer dated at the money call or put, and then you're selling a shorter dated, so a different expiration date than what you're buying, because debit and credit spreads, we're trading them on the same expiration date. When we're trading calendars and diagonals, the long and the short leg are of different expiration dates, but both strategies still have limited risk. So whenever we're talking about a calendar diagonal, we're really taking what we've learned and taking it to the extreme level. The difference between calendars and diagonals comes down to your directional view. Calendars are more neutral in terms of directional view. Diagonals are more for if you have a mildly bullish or mildly bearish view. So a calendar spread, well, let's start with calendar spreads, where you buy a 60-day out of a 60-day option, and then you sell perhaps a 30-day option against it. This way, you're buying the leg that has the least amount of time decay, and then selling the leg that has the highest amount of time decay. And you're trying to capture the difference between the two. Now, the difference between a calendar diagonal is that a calendar, the long and the short leg are of the same strike. So if you were to buy, let's say in this particular example, he's currently trading at 85, then I would buy, let's say, a July $85 call and then sell a June $85 call. And what this actually provides you with is a very creative way using options to get a risk profile that's very similar to shorting a straddle. And this is a strategy that we didn't cover here today because it's a much more advanced strategy. But shorting a straddle has unlimited risk. But there are many advantages to shorting a straddle, but the downside is that it has unlimited risk. When you trade a calendar spread, you get to have a risk profile very similar to shorting a straddle, but you have limited risk. And with both calendars and diagonals, the risk is limited to how much you pay for the calendar and diagonal. So really creative ways to allow you to trade different strategies. And then diagonals are similar to calendars, but the strike prices are different strike prices. So in this particular case, if I was to buy an $85 July option, I can sell maybe a $90 June option against it. So an out of the money, shorter dated option. And it turns it into a strategy similar to a covered call because effectively I'm long the longer dated option and I'm selling a shorter out of the money option against it. And that shorter dated out of the money call option will offset the cost of the long call or put that I'm purchasing. So it really allows me to finance the longer bullish or bearish view of an underlying stock by selling shorter dated options against it. And you can even take that to even a further extreme. Sometimes you could buy a 1-year option and then sell monthly options against it, the same way you could sell a cover call against the stock position that you own. So time spreads really take into account everything that we've talked about here and take it to a level that really allows you to maximize the best practices for buying versus selling options in a single strategy. And lastly, I'll just talk a little bit about managing these trades, because we've talked a lot today about what are the best practices to get into an option strategy. We talked through quite a few different strategies and what are the best practices for each one. But a lot of investors also have questions around, once I'm in a strategy, how do I know when it's time to get out? So we're going to talk about two things. We're going to talk about rolling options and we're going to talk about exiting trades. So whenever I'm referring to the concept of rolling options, don't be too confused by this terminology. It's really just closing out the existing option position that you currently own and establishing a brand new one within a single trade. We call that a roll. And even if you don't establish it in a single trade and you just do 2 trades back to back, that still technically is rolling your strategy. That's all that means, is closing your existing position and opening up a new one immediately after. So whenever we're thinking about when you're short an option, when you're selling a cover call, a cash secure put, or even a credit spread, what you want to do is you want to think about whether the option that you've sold is in the money or not. If an option that you've sold is out of the money, there's not much that you need to do. But if an option that you've sold is in the money, that option is going to be at risk of assignment. So what you should do, generally speaking, is that when an option becomes in the money, you don't have to do much immediately. But if the option that you've sold is in the money in the last 2 to 3 weeks before expiration, as you get closer and closer to expiration, 2 to 3 weeks to that, that's when you want to start rolling it, meaning buy back the short leg that you're currently in the money in, and look at selling a new out of the money call or a put against that. So you always want to roll it to an out of the money option. So closing your in the money option and rolling it to an out of the money option, and vice versa. If you're long a call or a put, in the money options, again, if you're in the money in the last 2 to 3 weeks, this is also where you want to roll. Just that the difference here is that you want to roll to an option that's basically at the money. And the reason for this is because an option that's in the money, that you're long, is certainly going to by rolling an in the money option to an at the money option in the last 2 to 3 weeks, what that allows you to do is to actually take some risk off the table. You're actually going to be able to trade that at a net credit, which means that you're going to take some profits or reduce the risk that you've taken on that long call or put, but still maintain further exposure in that underlying stock or ETF in the direction that you expect it to. Now, rolling strategies make sense only if you want to extend the time at which you want exposure in that underlying stock. So if you simply want to end the exposure of that underlying stock, you can simply close out the position and move on to the next trade. You don't have to establish a new one. So you only want to do that if you want to extend the amount of time that you want exposure in that underlying stock or ETF. And lastly, if you're concerned about assignment, part of the reason that we tell investors to roll a short option that's in the money 2 to 3 weeks from expiration is to help avoid potential scenarios of early expiration. We tend to find that early assignments, 2 to 3 weeks out, it's pretty rare to have an early assignment. But if you get into the last few days towards expiration, that's when early assignment does become more prevalent. So if you're concerned about early assignment, make sure that you try to roll 2 to 3 weeks out. If you do find yourself assigned early on a short position, don't panic. You can simply close out the stock position that you are now in as quickly as possible, because that's going to help you reduce exposure in the underlying option. And lastly, just to talk a little bit about exit rules. Whenever you're trading an option, you should always, before you get into a trade, have a sense for when you're going to get out of that trade. Usually this should be based on either a dollar amount in terms of P&L or a percentage amount in terms of P&L. Each strategy tends to have different best practices, so it's important to understand your strategy, understand the best practices, and make sure that you have alerts around deciding when it's time to get in and out. If you have predetermined prices before you get into a trade, you tend to be less emotionally attached to a trade. You know exactly when you're going to get out, when you're going to take profits, as opposed to figuring it out on the fly when you're in a loss or in a profit. You don't want to do that, because then emotions start getting caught up in the trade. So try to use a predetermined set of rules to determine when to get in and out. Whenever you have a short option, again, 2 to 3 weeks out, you have to start looking at closing those out or rolling them out if you want to maintain exposure. But don't let short options get down into the last 2 to 3 weeks. As you get closer and closer to expiration, you have that risk of early assignment, unless it's an option that you want to get assigned on. Those you can hold to expiration. So if you have a short put that you want to own the stock on, or a cover call that you want the stock to be called away, those are the only exceptions to that rule where you can let the option or a short option roll to expiration. And if you are going to do any type of roll or exit, make sure that that's done, in the last 2 weeks before expiration. So largely that covers what I wanted to share with you here today in terms of best practices around choosing expiration dates and strike prices. Like I said in the very beginning, when you're first starting out with options, many of the choices that you make with expiration dates and strike prices are rolled over from your experience from stock investing. But it's really important to understand that it's very counterintuitive to pick buying low, selling high when it comes to options, because it's actually sort of the opposite that you want to choose based on what we've learned from best practices of backtesting many of these strategies.
Wonderful. Tony, thank you so much for your time. And now we're going over into the Q&A portion.
Thank you so much.